Great to have you, Neeti, now. Firstly, just wanted to understand your NIMs. They saw a little bit of pressure. You are now expecting NIMs to remain in that band of 4.3 to 4.5%, which is kind of 20 basis points lower than your earlier guided range. We believe that it has a penal interest charge impact as well. But what has changed fundamentally which led to this decision other than that?
Good morning, Aisha, and good morning to your viewers. Absolutely right that we had a slightly lower guidance compared to the previous guidance, which we had given between 4.5 to 4.8. And currently, we have guided between 4.3 to 4.5. And there are two reasons for this. One is, of course, the cost of funds for the system and the ecosystem is going up. For us also, it has gone up a little bit in the last 1 year. Even on quarter, there has been a little bit of elevation because we all know the liquidity and the deposit pressures which most banks are facing. And correspondingly, we are not able to pass on, we means the entire banking ecosystem are not able to pass on the same thing because to the customers on the lending side, and that automatically puts some pressure on the NIMs. The second thing which has happened is the regulatory guidance on the penal interest. While some of that can be recovered through the penal charges, but on the actual basis, what we could do on the penal interest, and because we have a large golden portfolio, there is a slightly larger impact, which is somewhere around 20 basis points, 20 to 25, which automatically brings down the guidance by around 20-25 basis points. And that's where it is. Hopefully, sometime next financial year, once the interest rate starts coming down and liquidity challenges gets little more stable, the entire banking ecosystem should be able to return back to normal NIMs again.
Okay. This quarter, your treasury income was also high. Tell us a little bit about what actually drove this uptick, and is it likely to sustain then at the same levels?
So, Aisha, we do not consider treasury and PSLC income as a core income because we know that part of that could be one time, part of that could be depending on the yield curve, how it is moving. Of course, yield curves are moving favorably. I mean, in recent times, of course, the US yield curve has been sort of come down. Again, it has gone up a little bit, and same is happening in India. But eventually, the long-term trends, yield curves are going down, and hence treasury income hopefully will sustain for a while. But we don't take this as our core income. And our good news is that even if you take out the treasury and the PSL's income, our overall fee income to overall income has significantly gone up as a bank, and that is core to the bank, and that will consistently go up. Treasury is a cycle income, and of course, we have got a very strong team in treasury now who are also able to get us some more trading income at this point of time, and that should consistently go up. So we are in a good place there, in my view.
Good to know. Now, if I'm not wrong, you were fairly cautious when it came to the retail unsecured exposure, even in the last quarter. This quarter, we did see an uptake on the written-off accounts. The question is, going forward, where do you see the stress building in your book, and can your credit costs remain below 0.4%?
See, I think it's an industry phenomena. We all know that unsecured credit is going through a slight cycle, in my view. There is a little bit of a leverage, and that's happening across the industry. And fortunately for us, the unsecured book is below 5% of the overall bank, which is quite manageable. And from that perspective, while there's a little bit of uptick on that side, which is an industry phenomena, our overall book size is small. And to that extent, and we have not really grown. If you look at our microfinance book has degrown, our personal book has degrown, and cards has slightly grown over the previous quarter. So from that perspective, I think we are very cautious on the unsecured side at this point of time. And we don't really plan to grow that book beyond 5% of the overall bank. And whatever cycle comes, I think it will elevate a little bit, and then it will sort of taper down for us because the book itself is small, and that also we are not growing at this point of time. But I think the industry has a cycle on that. How long and how large the cycle is, only time will tell.
Grow 1.5 times the industry growth. You are being conservative on the retail growth. Your corporate loan growth as well is not showing strong signs. So just want to understand where the growth will be driven by. Will it primarily be by the gold loans?
See, gold, we are in a good place because of two reasons. One is we think from our compliance perspective, we have put a lot of things in place in the bank on the compliance side, and hence we are quite confident that operationally we are pretty strong out there. And gold prices also has been supportive. I mean, leave alone last 1 or 2 days what has happened, but in general it has been supportive, and it is expected to be supportive when the overall global inflations are starting to coming down. So from that perspective, I think we're in a good place on that, and we know how to do that business. Having said that, we are not depending on gold to grow. I think our wholesale business is going to grow significantly from here on. This year, so far, we have been negative to flattish, primarily because we have exited a lot of legacy relationships, and also some of our DA books which were there. We have exited those relationships because those are not really wholesale kind of business. And we have got a very good team now in the bank and who are building a very good wholesale franchise. So I think next FY will see a significant growth on the wholesale side. And I think starting from Q4 itself, we'll see that growth. SME has been growing consistently for us. I think all the cleanup which we had to do on the SME, we did it around 1 or 2 years back. Now it is on a good path. It will grow. And retail will see as and when we think that there is clarity on the cycle, on the credit cycle on that, we will be able to get in. And along with that, we should build up our quality CASA franchise, because we want to grow our asset book on the retail side on the back of a good CASA franchise, which we're working on. And that depends to a great extent on the kind of technology transformation which we're doing in the bank. And we will be a completely different platform 1 year from now on technology, which is what we are always there in the bank. So that will help us in building a great retail franchise. And retail is just not about retail assets, it's about retail franchise we'll build. Also, the retail fees are doing extremely well for us. And that is giving us a lot of confidence that our ROA should be sustaining over a period of time.
Good to know. And given that, there are chances of rate cuts, what's the outlook on the gold loan portfolio? Will that help you sustain the yields on loans? And how do you think the repricing will play out for you?
So that's a very important point. What typically happens is businesses like credit cards or gold loans, the sensitivity on pricing is very low. So what it means is that when the rates goes up, you cannot take the prices up, and when the yields up, when the rates goes down, you also don't necessarily need to take the yields down, because it's a very operational intensive business. So from that perspective, I think as and when the rate starts coming down, players with having a larger gold loan portfolio will have slight advantage in terms of rates and NIM. But we are not depending on that. We want to ensure that because our rates on gold loan are on the lower side of the industry, we are not in the range where generally some of the other players are there. So I think we are pretty competitive out there, and hence we think when a rate starts coming down, we should marginally benefit from there, specifically in the gold loan portfolio.
Right. Mr. Mondal, so great to have you on the show. Thank you for taking your time out and speaking about your earnings.
Thank you, Ash. Thank you.